Well, thank you for joining us. This week, Indorama Ventures reported second quarter earnings for 2023. Today, we're joined by Indorama Ventures Deputy Group CEO, Mr. DK Agarwal. Thank you for joining us once again, sir.
Thank you, Stuart.
So in the first quarter, we saw the beginnings of a recovery following some extraordinary market conditions and business operating environment. Have we seen that recovery continue through into the second quarter? And what are the top line numbers?
Yeah, so Stuart, these are one of the most difficult macroeconomic conditions which we have. We are still happy with the results in second quarter, but very difficult situation. Our volumes went up. The margins are under tremendous pressure. If we see the conditions, what has exactly happened is a question of stocking, restocking, and destocking. So in 2020, when the COVID hit, the margins went down, crude went down. In 21, when the supply chain was disrupted, there was a lot of restocking. Means that there was a tremendous demand generated. People were having a lot of safety stock. As now we are passing through the era of destocking. And because the supply chain normalized, the vessel timings reduced, people are not having more inventory because they are worried about the inflation hitting. So people are just getting high interest rate is holding the lower inventory. And as a result, we see a destocking. And China didn't strongly come back as we thought. Particularly services industries are doing much better than manufacturing. People are traveling more. It helps in PET side. So we are in a very difficult market conditions right now of destocking. We made 370 million core EBITDA, which is a reported EBITDA of $320 million. Still far behind what we thought. But the destocking, if I see PET has come to an end. First quarter our US operation wasn't running full. Now that has come back. We're still seeing downstream, integrated downstream destocking happening. Still margin pressures. The volumes are low, particularly in the crop solutions. Personal and home care is okay, but coatings are down. And fiber side, we certainly have a situation where automobile sector is recovering back. But what we see that the replacement tire demand is poor. So it is holding on. Automobile is a good sign. Lifestyle, again, China was having difficult time. So we saw that that is weakening. So very tough market conditions. That's what we have faced. But our capacity utilization has improved. And China's PMI has gone down. So we are in a very different situation, inflation in some parts of the country. And you have deflation in some parts of the country, like China cutting the interest rate. So difficult timing.
Now, we are a commodities producer for the large part, and to some extent beholden to the broader market environment and conditions. But what have we been able to do as a company or as a management team to control our own performance?
I think this is a time for management actions, very strong management actions, short-term, mid-term actions which we are taking. Short-term action is completing the capital conservation. We targeted $500 million in capital market day. Today I'm happy that at least $400 million capital conservation has been done, cash conservation in terms of working capital optimization, reducing the capital expenditure. We think by end of the year we'll do $500 million worth of capex plus working capital conservation. We have to work across all the sites to reduce the cost. I think our entire team is aware about it, and they're taking more steps to reduce the cost. Innovation has to double down. This is a time to take the stock of all the situation. We are optimizing our footprint in Europe, particularly in the fiber segments. Europe is making negative EBITDA today. So our European team is working hard. Even in CPET, we are looking at how to optimize our assets. So this is the time to look at our cost structure and be prepared, because our platform is robust. Our 70% platform still serves the product line which are resilient, but margins are under pressure, and that is the time for us to work together to be a leaner cost structure, put capital allocation correctly and make sure that we are prepared for the turnaround of the business in a more stronger manner. And these are all steps being taken.
So, Mr. Agarwal, we are at the midpoint of the financial year. How do you see the rest of the next 2 quarters playing out?
Yeah, so it's not going to be easy ride still. I think the macroeconomic situations are tough. As I mentioned, China is not showing sign. China property sector is not doing great. We certainly see the inflation. CPI number for US is going to come this day, closing, opening US. Interest rates are firm. So I'd see for our business a gradual recovery. Not a very strong recovery, but certainly in CPAT we are seeing plants are operating at a better capacity now, except for Europe. We see that these margins are not sustainable for Chinese PET because these are record low. 20% of the PET in the world is integrated with paraxylene, but 80% is not integrated with paraxylene. So we think some recovery in the margin should start happening. MTBE is strong because of the gasoline demand being strong. Downstream should bottom out. So some gradual recovery will start happening, and we'll see how the third quarter and fourth quarter. But I'm not so pessimistic.
Well, thank you for your insights, and obviously we wish you well for Q3 and Q4, and thank you for sharing your views with us.
Thank you very much. Thank you. Appreciate your time. Thank you.